If you've been trading with indicators like RSI, MACD, any kind of different oscillators, you've been wasting your time, and I'm going to explain exactly why throughout this video. Now, these indicators, they react to price movement. They're not there to predict anything, and they're often massive laggards. Now, I'm going to show you what really moves the market and how learning about market momentum based on volume and real institutional positioning is going to be your next breakthrough in trading. So throughout this video, we're going to be breaking down the concepts of what really moves the market and why indicators like oscillators like MACD and RSI tend to lag and really could be digging a hole rather than learning the real construct of market movement. So with that being said, I want you guys to hit that like button, hit that subscribe button if you are not already subscribed, and we're going to be jumping into the screens and into this video just right after this intro. Now, many traders, especially in the retail world, do struggle at the beginning, especially with these indicators. These are the most common tools, but for some reason, they're some of the least effective. Now, a lot of traders on the day trading perspective here, specifically talking about futures, have started with indicators like these oscillators, right? They provide more so post-move confirmation, not necessarily pre-move anticipation or even a hypothesis, right? Retail traders do rely on things like RSI or stochastics that might get extremely oversold or overbought, or MACD divergences, MACD crossovers, whatever the case is. But just think about it for a second. If you're an institutional trader, whatever the caliber is, and you have thousands and thousands of minis to offload on the NASDAQ or the S&P 500 futures, reality of the situation is they're not going to be looking at oscillators like this. They're probably going to be looking at something that we call volume, right? When we see these moves getting created based on these indicators, it's more so a reaction to the actual size that comes in, right? Markets, they're two-way auctions. A two-way auction suggests that buyers and sellers meet together to create what is deemed a fair price or imbalanced prices, and there are prices above and below fair price where they want to get active, but maybe at the current time they can't. So translating that into an oscillator like MACD and RSI doesn't really create some kind of cohesion or confluence. If you're following surface level signals while real market participants are reading behavior and positioning and repositioning, you're going to fall behind, and that's where retail really gets trapped in all of these different indicators. So realistically, we can take a look at any indicator here on the screen. We have this on TradingView, and we can see the RSI is at the bottom and this is the MACD. Now, there are instances where the MACD crossovers can work or divergences can work. I'm not saying that it's like, oh, it's 0% chance, but they tend to lag. Especially here with the RSI, you can see how things get extremely oversold with the market continuously grinding higher and higher and higher. So when we have these kinds of signals, right, many retail traders might think, okay, we're at a top, we got to start selling, and next thing you know, you get stopped continuously. Well, institutional or large strong-handed traders might be repositioning for the bullish momentum, right? Even these crossovers here on the MACD, you might think, oh, okay, well, realistically, they're crossing over. That means that there is an indication where prices are expected to turn back around, and you get maybe a few points here and there, and then we continue this upside momentum, right? It's not always a case where, oh my God, it's completely wrong 100% of the time, but the inconsistency in these oscillators creates more of a lag in the use of these indicators. So the question is, okay, that's great. They may not always work that well, right? There are instances where they can present some kind of upside momentum or downside momentum, and it could come together very nicely. But in reality, who moves the markets, right? What moves the markets? Because even if we're looking at crossovers or extremely overbought and oversold territories, like here, we get this expansion to the upside on the RSI. You get a crossover to the upside. We get a little pullback, but markets ultimately continue the trend. So there are instances where they can work, but all in all, right, trying to rely only on this really narrows the point of view. Now, I'm not saying we completely have to just discard these. They could serve a purpose, but if we understand who actually moves the market and why the market moves, we're going to get a very clear understanding as to why these oscillators aren't probably something that we could use consistently. So it's not necessarily going to be RSI, it's not going to be MACD, it's not going to be oscillators. It's going to be people placing size at different areas, right? It's going to be large money creating buys or sells that come and fight, that ultimately create some kind of imbalance that turn into market moves. So market movers, right, they're going to be institutional traders, they're going to be dealers, they're going to be desks like they're going to be prop desks, they can be hedgers, they can be hedge funds. It's going to be traders that move significant size, right? Mainly institutional size, banks, right? Repositioning, so on and so forth. It's not necessarily going to be what people deem as quote unquote smart money, right? It's going to be people that actually reposition size. They're not out there to hunt your stops as a retail trader. They're not out there to trick you necessarily. It's more so creating liquidity based on large market participants. So these traders move size based on inventory, liquidity, and value. They look to create value at specific areas, what they deem to be fair value. And not indicator signals, right? They're not going to be looking at RSI and MACD and saying, oh, they're flashing to buy, let's start positioning into the buy, right? The buys that happen in these MACD and RSIs are going to be a result of the positioning based on auctions, right? A two-way auction, buyers and sellers that come together. For instance, if we take a look at where the MACD and RSI might bottom out and where the market bottomed out yesterday, right? The NASDAQ bottoms out at 22,840, for instance. Right, this is a very important level. Now, if I'm just watching MACD and RSI, I'm waiting for things to potentially turn over. So maybe I start buying over here about 100 points from where the actual low is, right? It could serve me a decent purpose, but if I wait to see the crossover, I might be missing that bottom by like 60, 70 points, right? This is reactive to what is actually happening. What is actually happening is market participants are entering at an area that they deem to be imbalanced. So why that 22,840? You can see it's a major distribution bottom using a composite profile. These extremes are going to be where the strong-handed market participants arrive. So instead of me looking at this and waiting to buy after an 80-point move higher based on what MACD and RSI might be saying, I might be looking at this and thinking, well, if we're looking at a two-way auction, market participants want to hold within balanced areas, right? Where balance drops off, that's where we could expect activity from strong-handed traders, meaning that when we're at a distribution bottom and we're within it, I can look for a bottoming. So anticipating that 22,840 is going to be an area, I already know where I'd want to look for the positioning for that long side realistically without waiting for a 20, 30, 70 point move to actually confirm, okay, now I can get in. So what we're looking for in terms of actual market movement is going to be based on balance, right? Balance and the volume profile as well as order flow is going to be the easiest visual component to really understand where market participants, heavy-handed market participants, are actually expected to come in, right? They trigger at value shifts. So where the strong-handed market participants are expected to come out are areas where they have ease of positioning to create a move. What creates ease of positioning is not going to necessarily be a low volume area. It's going to be the combination of a low volume node that goes into a high volume node that creates a ledge, right? An edge, a ledge, call it what you will, but a volume drop off. So for instance, these areas, right? They're going to get active based on the extremes. So we can go a step further in understanding, right, what a two-way auction actually is. A two-way auction is the movement of any financial market, right? Buyers and sellers, they come together. We remember back in the day when we had floor traders and they'd wave around different tickets, right? Creating supply and demand. That is exactly what a two-way auction is. Someone says, hey, I want to buy at 840. Someone says, you know what, I want to sell at 841. Maybe we meet somewhere in the middle together to create that auction. Someone says, oh, I want to buy even higher. I want to buy 842. I want to buy 843. I want to buy 844. And the sellers keep dumping at higher and higher prices because these buyers keep coming in and stepping in. That visual representation, right, is predominantly created in an order flow scenario where whether you're looking at the DOM or you're looking at Delta, whatever the case is. But from a visual component, we can understand how this two-way auction creates value, creates fair value, creates balance and imbalance based on the volume profile. So instead of me looking at indicators to identify where reversals are, I can take a look at what the balance extremes are based on a two-way auction to understand, number one, where are those extremes? Number two, is price in fair value, is price balanced or is it imbalanced? Because a general rule of thumb is that if prices stay inside of balance, they would want to continue that momentum within the balance. That's where we get the idea to buy this 840 rather than waiting for some kind of cross or extremely oversold scenario to get in based on these indicators or oscillators. So when we look at things, right, institutional size or institutional traders, some more intelligent retail traders, they're looking at how supply and demand moves the market and where fair value is created, right? Where fair value in the market is created, that is where they want to position prices. And according to that, you get the visual that gets broken down in terms of the volume profile. So we have a composite profile here on the side. You can use anywhere between 200 and 400 days to create this composite profile here in the gray. I have a weekly composite profile, then I have session by session. The lighter background is going to be the ETH, the darker background is the RTH, right? And this is Sierra charts, and we're comparing it to TradingView over here. Now, I don't see anything wrong with using TradingView. TradingView has individual session profiles as well as larger profiles as well. It's just a good component to compare how these oscillators compare to the actual auction movement, which we see on Sierra charts. So, like I said, auction theory and context, right? Context is going to really shape up the idea as to how markets actually move, right? Auction theory, two-way auctions, is one big component of understanding what really moves the market. So don't get me wrong here. What actually moves the market is going to be volume and the understanding of how volume interacts to create shifts. So volume can be seen and identified in several different ways. Now, the way that I perceive volume is going to be easiest seen on volume profiles because, right, that's the epitome of volume, and understanding auction theory. You can look at it even from a different perspective, more so with order flow. Some traders even go above and beyond to look at it from a price action perspective, but from a price action perspective, it's not as clear. This is the bread and butter of what volume actually looks like, so why not use the easiest tool to actually explain it, right? Markets, they're an auction. It's a two-way auction, like I said. It's not going to be a random walk-in price. There are going to be positioned buyers and sellers from most recent price action movement that create upside or downside moves, right? Markets move from balance to imbalance to balance. It's a natural rhyme, right? It's just a very easy understanding of supply and demand. When demand and supply are equal, what happens is markets stay and create this balance. This happens the majority of the time, 70 to 80% of the time. Markets are going to stay in an area of fair value where no new information comes in, and we range, right? We create this range. Then eventually some kind of news comes out, and then supply and demand can be greater than the other to create a move that's expansionary and moves into either a new balance or creates a new balance, right? And then this is how markets cycle back and forth, back and forth, back and forth. So if we understand where these balances are, right, it makes it a lot easier for us to understand directionality and where strong-headed market participants are going to be active, meaning those extremes. So the volume profile shows areas of value, right? A composite profile, it shows an area of major value. Individual profiles, they show up areas of value as well, right? Where we'd want to see prices moving into value to create acceptance, right? We have areas of imbalance, which are rejections, meaning that if we move into an area of imbalance, we have the expectation that prices are going to hunt the next balance area, right? Staying inside of balance, prices want to stay there. Going outside of balance, they don't last too long. It happens about 20 to 30% of the time that markets stay outside of a major balance. So this is where participants actually shift. Understanding the movement from balance to balance is understanding how market participants actually shift and how strong-handed traders actually create market movement. Weak-handed traders or retail are the ones that follow, right? They're the ones that look at these RSI, MACDs and try to follow along with the move and not get slapped around. For instance, if we have this major balance, if we're inside of the major balance, meaning even from the top or the bottom, I want to play the extremes of that major balance until we get a momentum move that comes out of that major balance, right? Even over the last few days, when we get an expansion to the upside, we go into a new all-time high, right? Fair enough. Now, when that expansion fails and we close back within the balance, what happens is we want to see the other side of the balance. Now, strong-headed participants, they're most active at areas of extremes, meaning the low volume node that we talked about going into the high volume node. So if I can understand where those major areas are in a composite profile, that really helps me out. There's also the instance where we can identify on individual profiles to give us more of a defined, right, maybe minute outlook on where these extremes are. For instance, we have a balance area like this on this individual profile over here. The balance area, number one, starts off into this drop-off, and the second one starts into this drop-off. So if I'm looking at it from a contextual understanding, the larger component is that from a composite profile, we expand from the outside. If we close outside, we have the expectation that the strong-headed market buyers that have created this expansion are going to hold outside of this value, right? So what is a composite profile? What's a session profile, and how do these give context? We talked about this a lot, but did we explain it? Nah, maybe. A composite profile, right, is a profile that has several days that create volume. The beauty about it is people often ask me, okay, what kind of composite profile do you use? It doesn't necessarily matter because they show you balances, they show you the same balances regardless of the length. Now, a composite profile, I generally look at a 200 or into a 400. Generally, somewhere in between here, it's going to give me a very good understanding of what the major balances are. I'll look at a weekly composite profile too to understand where the most recent balances may shape up. For instance, this is the weekly profile. The balance top is the exact same balance top as the major composite profile. This is a great tool, and I also can look at, there might be an area in between that is created based on the individual session balance as well as the weekly balance and the large composite profile. So I have multiple areas that coincide, that create confluence, that agree with the composite profile. These session by session profiles are great to look at in terms of where the individual balances are. So if this all sounds kind of crazy to you, and it's not necessarily what you know about volume profiles, you might want to consider this, because volume profiles are more than just me trying to understand where the value area high and low are, where the point of control is. It goes a lot further. It goes into where the major balances are, what shapes the profiles look like, where the heaviness and lightness of volume comes out. We have a lot of videos based on that, so I'm not going to dive into it a lot, right, into this video. So these give context. They don't just give signals. They give you areas where strong-headed market participants are expected to appear, so you can anticipate those moves rather than waiting for some kind of lagging confirmation. Now, if we go even a step further, right, and we start talking about the actual market participants and movers, we start looking at things like order flow, right? So the volume profile, it can give us a nice layout. It gives us the map, right? It gives us the overall understanding of where value is created, where fair value is, where unfair value is, the overall map and schematics of the whole system, where we want to trade. The order flow, it gives you the timing, it gives you the aggression, the passiveness. It shows you everything in real time of market participants coming together to create these moves, right? This is where different types of order flows may play and come into play, but the main thing that I would want to look at, And the easiest thing to wrap my head around is going to be the understanding of delta, the creation of a delta profile. So you can look at things like the footprint chart. We have, again, videos on things like that. But this delta, this real live delta, is going to show us the real-time strength and weakness, right? Not necessarily trying to guess it from some kind of oscillator like RSI. So for instance, if we look at delta and the creation of delta, we see obviously down into some of these major areas, it doesn't look super clean right now, but the creation of absorption of delta into an auction low. Specifically at these other key areas that we have noticed, right, based on the most recent distributions, we've created very, very heavy absorption of delta, which suggests that, you know what, if we manage to move prices back above, this is a secondary tool of confirmation to really pinpoint the directionality and strength, rather than me looking at this thing and thinking, oh, it might be overbought or it might be oversold. So we can see that the absorption, the creation of this negative delta, tells us that there's a lot of passive buying and sellers are failing a lot. Just as we can take a look at delta into some of these highs in the most recent movement and think, okay, well, recently, realistically, we have the absorption into these highs, this positive delta. We have a nice distribution extreme over here as well. So once we start toppling back over, that's the failure that really confirms that markets are actually overbought or oversold. It's where strong end market participants create imbalances. That's how markets move. It's not about just indicators and blindly looking at these oscillators, right? If we look at indicators versus context, this is where the real shift in thinking happens. Indicators, right, they kind of give you a signal without a story. They kind of drive you back and forth in terms of these oscillators, and you might be thinking, oh, okay, well, it's time to get long, it's time to get short, you know, and there's not really too much of a story behind it. Now, you can even use some of these indicators once you have a better understanding of the context and the story. When we take a look at the volume profile, we add the auction, we add the order flow, it turns into context and the intent of real market participants to get us a better understanding of, okay, where is the direction headed? Where do they want to get active and when, right? You're not reacting to a line realistically. When you're using auction theory, using a two-way auction, using order flow, you're actually reading who is in control and what are they doing. So for instance, we have this bottom based on this auction area down here into the 22,840 that we've talked about on the NASDAQ. So we know it's an auction area. The delta profile, maybe it didn't look super attractive at the time, but when we take a look at this from another delta component, you can see how heavy the selling is into this low. It's very, very imbalanced selling, and then all of a sudden the buyers move through the sellers. When we start to see buy side that moves through the most recent sell side, this is where we can identify there could be a turning point for that upside expansion. We talked about the 920 area again, right? Maybe we're not super confident, so we wait to see what 920 does. When we get into the 920, we establish a major support structure with order flow trying to rebid key areas, right? So we have this kind of imbalance that confirms, you know what, we're seeing that expansion, and we can look at this, that real strong end of market participants are coming in to gain confidence rather than me looking at some kind of oscillator in that case. So when I combine all these things, I create context, I create confirmation, it gives me more confidence than me just looking at indicators, right? Whatever the case is, you want to be looking at context and what actually creates real heavy-handed market participant action. It may not be auction theory, or it may not be auction theory that really, really gets into your mind, but something of the sort that really establishes the read in volume. So you don't necessarily need more signals, you don't need to follow these things, you don't need to jump into indicators, you don't need to follow anyone, you need to understand how to read context based on volume, because volume is going to be the ultimate mover in the market. So you don't want to keep depending on lagging tools, you want to start learning how real traders see the market. So volume, whatever the kind of premise that dictates volume, whether it's auction theory, whatever the case is, volume and order flow create clarity rather than confusion. So if you guys really thoroughly enjoyed this video, we have even more for you. Down below, you can get a free PDF, right, to end the cycle. End the cycle of back and forth churning of the wheels as a retail trader. Understand how volume actually creates market movement. With that, you can join our upcoming webinar when you get that free PDF. So I want you guys to check out community.tradeproacademy.com for our free open Discord, and like, comment, and subscribe. I'll see you in our next video. Let me know down in the comments below what you guys want to see.